Welcome to Your Money, Your Call.
Welcome back to tonight's program, and our topic is personal finance. We're covering the whole gamut of questions here: superannuation, retirement, credit card, property, shares, you name it, we're talking about it. So if you have a question for our expert panel, call us 1300 30 34 35. Let's go straight to our next caller, and it is Joanna from the ACT. Hi there.
Hello.
Hi, how can we try and help you?
Hi. My husband and I have both read Jamie's book, What I Didn't Learn at School But Wish I Had. It's a fantastic book. Thank you for producing it, Jamie.
You're welcome.
Just a bit of background. My salary, I earn about $400,000 a year. My husband earns about $220,000. And as a result of reading your book, we've defined a set of goals for our finances. The goals are pretty simple. We want to obviously own our own home. We want to be able to sort of build an investment base that will allow us to retire. We have 3 small children. I work full-time, so does my husband. So we want to be able to use an investment base to spend more time at home and have a good quality of life. Now, based on your book, we have worked out that, we want to have we currently have about $600K net worth behind us, which isn't a lot. By the way, I'm 36, my husband's 43. And we want to really build the $600K net assets to $3 million net assets as quickly as possible. Based on the strategies in your book, we have sort of devised that we need to put about $800,000 into growth type assets and about $200K into momentum type assets. Now, we already have residential property. We have an investment property in Sydney and another one in Queensland. Based on the strategies in your book, the $800K of growth ought to go, I think, into some more residential investments. The question I have specifically is that at the back of our minds, we also know that we'd like a family home in the eastern suburbs of Sydney, and we're being tempted to spend the $800K, perhaps actually up the $800K of growth into a $1.4 million investment into a home, which is / investment / our future family home in Sydney. And I'm just wondering, do we need to switch the heart off in order to become better investors?
Okay, well, let's go to our panel, see if they can help. I think there's many people who would like to be in Joanna's position. She's a bit spoilt for choice, isn't she, Jamie?
Yeah, I think what you have, Joanne, is what you call a quality problem. You're in a very good position, and I understand your question is in the sense that, do you go proceeding with investing to build up your goal to $3 million, or do you go for your dream home now? And it's the question that a lot of people face: should I buy my dream home now, etc. There's 2 ways to look at it, and at least you've got choices, so it doesn't really matter what you do. But if you got what you can do, a lot of people think they have to buy their dream home, and often, unless it's going to be a good investment, what you're buying, sometimes you're better off renting your dream home. I've told a lot of people this. You can rent your dream home, especially in Sydney, for a fraction of the price that you can in your monthly repayments, and you could free up that extra money instead of tying up in your home. You go and invest it elsewhere into more investment properties or into cash flow opportunities in the share market. So you do have that choice. So don't always think you have to buy your dream home. You can actually rent it.
Micah, I'm just thinking though, generally speaking, property prices are on the way down though. Is it perhaps a good time though to buy, especially if she's looking for Sydney?
Well, in Sydney they have been on the way down for some time, and depending on where she's looking to buy, Joanna's looking to buy, would determine that. Some of the outlying areas of Sydney fell pretty sharply after 2003, 2004 have stayed fairly flat. However, properties in some parts of the eastern suburbs, and especially prime property either near the coast or near the water, in terms of the harbour, have just continued to grow strongly. So it really just depends on where they are. But the general consensus is that because of a shortage of property, certainly in Sydney and Melbourne, we're now starting to see prices edge on their way up because there's actually a shortage of property. Now, interest rate rises we've had recently we've seen evidence of a slowdown of construction, new starts. Therefore, it's probably going to put greater pressure on prices. We're going to start to see, and I saw a report the other day, we're going to see prices start to edge up again.
So what do you think? Go for the dream home or go for building of assets?
Well, I think the idea that Jamie said there of actually perhaps renting your dream home to see what it looks like first before doing that's a great way to perhaps ease into that. If that's your dream, Joanna, and it's part of really what you're trying to do with the plan that you've constructed for yourself, then I encourage you perhaps with the advice that Jamie's given you to perhaps pursue that, yeah.
Jamie, just quickly, Joanna did mention in her question about growth assets and momentum assets. Can you very briefly just explain what the difference is?
Yeah, sure. What I talk about is a concept of, I guess, if you look at all your investments overall, the security investments, which is maybe cash and super might go into that. Growth investments would typically be like residential real estate, maybe some conservative share strategies, blue chip stocks, etc. And momentum are more higher risk strategies where you can get much higher returns, but you take on extra risk and more for sophisticated investors. Where if you spread it across, you might say, as an example, have 10% in momentum. Money you can afford to lose is effectively what you put into momentum.
Yeah, I guess the thing though, Mike, isn't it, diversification is the key, especially at times like now where there's a lot of volatility.
Yeah, certainly, and Joanna has done that. She's had some diversification. I guess the issue that I talk to clients about is understand what you're getting into. So if momentum is a little bit more risk, understand the nature of the risk that you're getting yourself into. Because I guess recently we've seen people get into investments that they didn't quite understand, even some really sophisticated investors, and they've sort of said, but I didn't understand how this worked. In fact, it seemed nobody understood with some of the failures we've seen how they actually worked. So a bit of caution there, I guess. Okay,
our next caller is Shane from Victoria. Hi, Shane.
Hey guys, how you going?
We're all well, thanks.
I'm just calling as I have a half share with my brother in a $400,000 house at the moment, which currently has no debt, which is very, very good, I must admit. But the problem is for me is I'm at uni and I have a small wage that I can't really support the house very well, in loans. And my brother has a large debt, but he makes good money. So we're having problems at the moment getting loans. And I was just calling to find out, I guess, any advice from you guys about that.
Mike, I'm going to go to you first on this one.
So Shane, you're at uni, did you say?
Yeah, I'm at uni, yeah.
Yeah, okay. Can be a little bit difficult to... Are you looking to borrow to get into property? Is that...
I guess borrow to invest. Shares, property, whatever would be the best, I guess, strategy.
Yeah, okay. Look, I guess there's a couple of options, although if you're at university, it's a little bit difficult to certainly go to a traditional lender, and lenders are a little bit nervous right now. I guess there's a pretty limited range of options. I would think, I don't know, Jamie, if you've got any strategies that for someone who's in uni.
Sure, what I do, I mean, Shane, it really depends. Obviously, you bought this property with your brother, whether you intend continuing to do that, whether you want to invest with him. But you're saying that, it's $400,000 and you own no debt on that, even though you have a small income, but he has an income, but you're saying he has some debt outside of that. With low doc loans and no doc loans, you should still be able to access some equity in that property, especially if you're working with your brother. Now, it's up to your brother whether you want to invest together. That's probably the critical thing. But you've got no debt on that, so you can access some equity, even if it's a small amount, and then you can go and obviously invest that, whether it's in the share market or the property market. So you do have options, and you might want to explore that, low doc and no doc loans.
Well, good luck, Shane. Okay, we're going to go to a break and we'll be back with more of your questions about personal finance in just a minute. Don't go away.